Hi guys. So we are going to conclude the chapter by discussing the costs of inflation. Now, in doing that, what we are going to do at the beginning is first clear out our mind from some mistakes that, that often we make when we think about inflation. The first mistake or fallacy is to think about that inflation somehow affects real wages in the long run. Remember, guys, real wages or our real income, everything that has to do with real stuff, is not affected by the Federal Reserve printing money or by inflation in the long run. Remember that the wage, or better, the real wage, is connected to the marginal product of labor, okay, is connected to real thing. So inflation, first of all, the cost of inflation is not that erode our real income, okay? Once we clear that out, we are going to realize that in any case, there are costs of inflation. And the way we are thinking about this is classifying the cost of inflation in two main categories, in particular cost of expected inflation and cost of unexpected inflation. The cost of expected inflation have to do with the cost that arise from inflation that is expected. It's important people form, if you want, expectations about what the inflation is going to be in the future years. And these costs have to do with inflation that actually has been expected by the people. Now, the cost of expected inflation falls in five main categories. In particular, shoe leather costs, menu costs, misallocation cost, confusion and inconvenience costs, and finally, a last cost that arise from tax distortion that are due to the fact that our nominal income is taxed and not the real income. So let us start with the first of these costs, the shoe leather costs. Now, the shoe leather cost has to do with the fact that in presence of very high inflation, so when the quantity of money keeps growing, people tend to avoid to keep money in their pockets, okay? And the reason is pretty simple. Inflation erodes the value of money, is a tax on the people that hold money. So what these people will do when you receive an income assistance and you are a worker, well, you run directly to the bank to deposit this income. Same, you just take the amount of money that is needed for the supermarket to the grocery. So you go to the bank, you take the money, you go to the supermarket, you make your purchase, and then you forgot that you needed to buy more than what you expected. So you go back to the bank, you take other money, then you go to the supermarket and you make your purchase. Now all these trips erodes your shoes. And therefore, the costs that arise from expected inflation due to the fact that you do many trips to the bank are called shoe leather costs. Now, the second cost are menu costs. And these costs have to do to the fact that in presence of high inflation, restaurants and other businesses need to print their menus more often in order to match the value of prices that has increased due to the inflation. The third cost is the misallocation of resources cost, and arises from the fact that inflation alters their relative prices. And in particular, it does not uniformly change the same price at the same time, but affects the price at different time. It might affect first some product and later some other product. So affects their relative prices. since relative prices determines the allocation of resources, determine how resources are scarce, inflation by altering the relative prices might actually affect the allocation of resources in the economy. To do The fourth cost has to do with the confusion and inconvenience that arises from the fact that inflation affects money as a unit of account. Remember, money is our meter, is our yardstick that we use in order to assess how scarce are resources in the economy. Now, what happens when there is inflation? This unit of account changes over time. Think about as if the meter or the yardstick had to change every year, even in an unexpected way. It creates inconveniences. As instance, it's going to be more difficult to compare dollar amounts over different periods of time. It's going to make it difficult to make even, to assess how much our income has to grow in order to maintain our purchasing power. So in a certain sense, it's going to be difficult to make long-term planning, even if inflation is expected. The fifth cost has to do with tax distortion costs that arises from the fact that your nominal income is taxed and not the real income. And therefore, inflation, by affecting the nominal income, might actually vary the real amount of taxes that you have to pay. And for this one, let us discuss an example from the slides. So, tax distortion had to do with the fact that taxes are based on nominal income and are not based instead on real income. And sometimes inflation makes nominal income grow faster than real income. As a result, you are taxed more than what you should in real term. Let us give an example. On January 1st, you bought $10,000 worth of Starbucks stock. And on December 31st, you sold the stock for 11,000. So your nominal capital gain, how much you earn, is $1,000. So 10% of your initial investment. Suppose that this inflation is 10% in that year. Then your real capital gain, how much you have earned, is actually zero. The interest rate is 10%, inflation is 10%, so your purchasing power has increased by zero. Or another way of putting it, the money in your investment has increased by 10%, but all prices have increased by 10%. So in terms of real purchasing power, your investment has been worth as zero, has protected you from the inflation. Now, the trick is that the government requires that you pay taxes on this $1,000 nominal gain. And that explains why tax that are applied on nominal income and not on real income might actually have a real effect, might actually have costs, so real effects on the economy. Let us now move to a second set of costs that involve costs of unexpected inflation. That is, inflation that is not expected by the agents. Let us start with the cost of unexpected inflation that has to do with arbitrary redistribution of wealth. Now, the issue at the basis of this cost of unexpected inflation is that many long-term contracts are not indexed, but are based on expected inflation. As instance, when you go to a bank to ask for a mortgage, the bank forms expectation about the level of future inflation, try to predict future inflation. And what it does then eventually determine an interest rate that is actually based on this expectation. Similarly, when you want to bargain your wages and you want to determine the growth of your wage, you make prediction, or unions make prediction about the expected inflation. Now, the important part is that the inflation that is realized might be different from the inflation that is expected. In particular, there are two concepts of inflation: realized inflation, which is the one that we observe in a particular period of time. This is that we read in the newspaper or we hear in the news. And this concept is different from the inflation that is expected. That is the inflation that we expect to observe in the period, and that is embedded in these contracts. When the realized inflation is different from the expected inflation, well, there is a reallocation of resources from the two parties in the contract. As instance, in the mortgage contracts, there is a reallocation of resources between the lenders to the borrowers, or from the borrowers to the lenders. Let us be more precise, and in particular analyze the borrowers and lenders relationship. Now, if the realized inflation, the one that we read in the newspaper, is higher than the expected inflation, then there is a transfer of purchasing power from the creditors to the debtors. The debtors, if you want, get richer. And the reason is that if the realized inflation is higher than the expected inflation, then the real interest rate you pay is actually lower than the expected one. And we can formalize with a simple equation. This was the expected real interest rate that was predicted to be paid by the two parties when they enter in a borrowing lending relationship, as instance in a mortgage. They made prediction about the expected inflation and they set the nominal interest rate, if you want, predicting this real expected return. But now it turned out to be that the realization of inflation is higher than expected inflation. So the real interest rate that you're paying is actually lower than the expected one. So higher realized inflation than expected reallocates resources from lenders to borrowers. Which is, when you hear in the news that inflation is higher than expected, well, actually, if you are a borrower, you are richer in that moment. So debtor gets to repay their debt with dollars that aren't worth as much in that moment. Conversely, when inflation, the realized inflation that we read in the newspaper, is lower than expected, then there is a transfer of purchasing power from the debtors to the creditors. So the creditors can actually get richer. And again, we can use the same formula to realize that. So purchasing power, if the realized inflation, this pie, is lower than the expected, what will happen is that the realized rate of return is actually higher than the expected. So how much in purchasing power as a debtor you have to pay back to the lenders is actually higher.